Hello and welcome to IORMA's first webinar for 2021. What trends will most impact consumers in 2021? We have an absolutely fascinating group of panelists joining us for the discussion today, and I will introduce them all very shortly, but they are spanning several continents, joining us from Los Angeles, London and Vienna in Austria. We're absolutely thrilled to have you all, and to everybody who's joining in to listen to and contribute to today's webinar, a very warm welcome and of course a Happy New Year in these challenging times. A few words of introduction to those who haven't joined an IORMA webinar before. The IORMA Consumer Commerce Centre is a neutral resource for businesses and governments that recognise their need to understand and respond to the ways in which the 7.8 billion global consumers are changing, and the products and services that they want and need, and the ways they want to obtain them. These changes are happening globally, driven by developments in society, in business, and in technology. Now, I'm going to ask and put questions to our panelists, but also I'm very keen to encourage all of those listening today to put your questions up into the notes section online. We will go through now to meet all of our panelists individually, and I'd first of all like to ask Graham Leach, economist, well-known, renowned economist Graham Leach, to say a few words of introduction.
Thank you, Beverly. Well, good afternoon, everybody, and welcome to this seminar. I'm very much looking forward to it. I founded my own company called Macronomics, which is a macroeconomic, geopolitical, and future megatrends research consultancy. But before that, I spent 15 years as chief economist and director of policy at the Institute of Directors in London. And as many of you may know, that represents around 30,000 company directors in the UK and across the globe. And that was inputting into economic policy analysis, representing the IOD to the Chancellor and Number 10, but also commenting on the economic outlook as well. And I guess that's my first love, thinking about the economy and what it means really for business. So that's me in a nutshell.
Thank you so much for that, Graham. Welcome. Look forward to your views enormously. I'd like to go now to Jeff Cole, who's joining us all the way from LA. Jeff, renowned for your experience in digital tech and media communications, but please do introduce yourself. Oh, you seem to be muted, Jeff, by the way.
Sorry. Thank you, Beverly. I'm Jeff Cole. I run the Center for the Digital Future, which is affiliated with the Annenberg School at USC. And I have been tracking digital for the last 22 years, convinced that almost everything can change from digital. And we have been doing an enormous amount of work during the pandemic. Most of us were given 3 days to move our work lives, our school lives, our buying behavior, our entertainment online. And what couldn't be done online couldn't happen. And I think coming out of this, and we'll talk about this, I think this is the first time since the end of the Second World War where we're going to look at everything in our lives, including buying behavior, and rethink it. Everything is subject to change, and we'll talk about some of that change as we go on.
Thanks so very much for that, Jeff. Very warm welcome. I'd next like to ask Greg Swenson, partner at Brigg McAdam, to talk a little bit about your background and introduce yourself, Greg. Very welcome.
Thank you, Beverly. Really great to be here. I'm an investment banker based in London. I spent my formative years in the US working in debt capital markets for Lehman Brothers, and then followed by HSBC. And with HSBC, I came over to London quite a bit and really developed an exposure to the rest of the world, but notably emerging markets. So our firm is based here in London. We focus on emerging markets in general with a particular focus on Africa. We're active in Eastern Europe and Southeast Asia as well, and basically raising capital for critical infrastructure and renewable energy and agriculture.
Thank you so much for that, Greg. Warm welcome. And our final panelist today, Kurt Beyer, from the Vienna Institute for International Economic Studies. Very warm welcome to you, Kurt, and please do say a few words of introduction.
Thank you, Beverly. Yeah, very briefly, I was working for 25 years in an economics research institute, and I switched to the Austrian Ministry of Finance and had a lot of economic policy advice experience with Austria, but also, of course, with the European Union, because Austria had joined there just when I came there. And then I was on the board of the World Bank for a couple of years in Washington, D.C. And from there, I switched to the board of the European Bank for Reconstruction and Development in London. And I came back there, from there to Vienna in 2013. And I'm now essentially a consultant. And I participate in discussions like this and do a little bit of lecturing. I'm mainly interested in economic policy questions. And that will be my take for today. Thank you.
Thank you so much. Well, I think everybody can see what an incredibly experienced set of panelists we have today and the wide range of experience that they're going to bring to the topic for today. What trends will most impact consumers in 2021? And I'm sure that we'd all agree that we have been through the most dramatic period of change in the last year. For us in the UK, of course, we've been through Brexit, but all of us internationally, globally, are impacted by COVID, and our Prime Minister refers to the current COVID variant as creating perilous times, and our Chief Medical Officer warns that the next few weeks will be the worst of the pandemic. So in this webinar today, we are looking at times where disruption is becoming far more the norm. And it's in that context that I really wanted to turn now to each panelist and ask them to give us their thoughts on these really big trends that we are looking ahead at, perhaps over the next 5 years or so, from their experience and perhaps their sectors, and to give us an overview before we perhaps go into more of the detail. And I'd first like to come again to Graham, and I ought to just say that Graham is going to have to leave a little bit early, and when he does, he will just literally leave us. So I thought perhaps the first word should go to you, Graham.
Thank you, Beverly. Well, I mean, I maybe just touch on maybe 3 or 4 issues which I think are potentially going to be very, very significant. But everything has to start somewhere, and I think any view of the future has to be predicated on some assumptions, and assumptions are the enemy of forecast because they're the ones that really undermine them every time. But if we start with 2 assumptions in a UK context, at least, that the vaccine will be rolled out on something along the lines and the time frame that the government expects. It may not be hit precisely, but that sort of order of magnitude and timescale will be satisfied. And second is that, yeah, we went back into recession in Q4. That will have continued into Q1. In other words, we'll have 2 quarters of some consecutive quarterly declining growth. But then post-vaccine, second quarter onwards recovery. So based on that, what do we think is going to be happening, and what sort of bounce back are we looking at? And I think the key thing there is confidence, the confidence to go out and spend. One of my colleagues thinks we're all going to go absolutely berserk when lockdown lifts, and we're confident that with the vaccine we've got sufficient levels of herd immunity. He informs me that he's going to go down to the pub and not move for 3 days. So I'm not sure that's in his employment contract, but there we are. That's what he's going to do. So to what extent that idea of going berserk will be manifested across the whole economy is open to question still now. There's a big issue there. But the one thing we do know, the hard data we do have, is that there has been an enormous surge in savings. The household savings ratio rocketed in Q2 last year. Now it's come back a little bit since, but it remains very, very high. So the potential for spend is undoubtedly there. The question is, to what extent will confidence factors encourage that? Will people be, yeah, this is all behind us? Or will it be, well, is there going to be another mutation? Should we be just keeping some money for a rainy day? We don't know the answer to that question yet, but confidence is going to be such a huge factor because of the scale of economic gyrations in consumer spending. Although having said that, remember that overall retail spending in the UK is actually pretty flat over the past year. It's only down about 1%. And that, of course, is because of the massive split between the online and the high street, with online going from 30% pre-lockdown to 60% of the total retail spend at the peak of the lockdown, and it's still around 50% on the latest figures. So if that wall of money begins to move, where will it move to? Will it move online, or will it move back into physical retail space? Interesting question that has to be answered. Second key point is just on fiscal policy. I don't think that the post-crisis fiscal policy is going to be anything like the post-financial crisis fiscal policy. In a UK context, there is no real appetite for austerity. There's certainly not appetite for austerity anymore in terms of reducing public expenditure. I'm not making a value judgment as to whether that's right or wrong. I'm just saying what seems the political reality. That means that with a very big deficit, how do you get the adjustment? Do you just rely on an economic bounce back? That's really probably not going to do it, as far the government's probably not going to think it needs to do more. Does that mean then all the burden falls on taxation and not expenditure? And you get that wrong, and you could tip us back into recession. So you do more damage potentially by raising taxation than cutting expenditure in terms of the growth effects, in my view, and certainly in the historic experience in the UK. So post-crisis fiscal policy, the second one. Third one is just that I think we've got it. This is one area that is going to be a shock to everybody, but quite simply, we don't know what's about to hit us, and what's about to hit us is a wall of inflation. People think with rising unemployment, loss of output, everything depressed, core inflation already below 1%, more towards zero, what possible reason could there be for accelerating inflation, and a significant acceleration in inflation? And the answer is quite simple: the growth of the money supply. In the US, for example, the money supply growth last year at times was the fastest in peacetime history. In the UK, money supply growth, the latest figures, is 14% year on year. Now, our underlying potential growth rate is 1.5% tops. And so you've got this massive divide between what the potential nominal growth in GDP will be, i.e. the growth in the broad money supply roughly, and what the underlying real potential is. And even with an economic bounce back, let's say this year and into next year, that still leaves a mighty big gap for inflation creation, in my view. So inflation could be the thing that we didn't anticipate, don't expect. We've been conditioned by the death of inflation. Expectations have adjusted dramatically over the last 20 years. They could be about to adjust towards the resurrection of inflation as well. And I guess finally, sorry, I'm hogging this a bit because I know I've got to go early. But the final thing is that I'm writing a book on this at the moment. I'm arguing there's going to be a great inflection in productivity growth in the 2020s, in the mid 2020s. Again, we've been conditioned on the idea of secular stagnation, and the fact that despite all this technological revolution, productivity is just flatlined. And people have talked about the Solar redux, that's the Solar paradox in the late 1980s about IT everywhere, but in the productivity statistics. Well, the idea now is that we've got a redux of it. And my argument is that actually this is precisely the wrong time in economic history to be looking at the road ahead through the rearview mirror, because that says weak growth and productivity. The maturity, potential scale, and the convergence of AI, 5G, IoT, big data, 3D additive manufacturing, all these things are coming together in the mid 2020s. We're at the beginning of the upswing in the exponential S curve here. We're not much higher than that, but that's going to mean that productivity accelerates. And so these are going to be interesting times. We're going to get a little bit of a turnaround, I think, in the late part of this year and into next year, which sees inflation. But in a couple of years, we're going to see something which we really, really don't expect, and that's a sharp upturn in productivity growth. Thank you for your time.
Marvellous, thank you. That's given us lots of food for thought, and I think very interesting number of points being made there in terms of this wall of consumer money and these slightly berserk consumers. the
My berserk colleague, maybe.
impact of digital, which I think is particularly interesting, and I'm going to come to Jeff next in LA, the potential wall of inflation, and if I understood you correctly on your last point, a productivity kicking in through AI, 5G, and so forth, but not immediately, I think. Is that what you're saying? We're on the bottom end of the S.
Well, it's progressively, it's already there to some degree, but it's weak. But its overall impact on the economy and its impact on productivity will begin to accelerate sharply in the mid-2020s. There are good reasons why it's not happened today, but
I'll let 2 years to get there then. And are you going to give us a number for growth this year, Graham? Because obviously we're all very interested in that.
Oh gosh, that's anybody's guess at the moment. We've got a second quarter bounce back, but this is all epidemiologically driven. So speculating on the economics is hard. Speculating on the epidemiology is even harder. So yeah, okay. We'll get what looks like a 5 or 6% growth this year, probably in the second half, okay. But it's not going to feel like that for quite some time.
Oh dear, right, so waiting again. But Kurt, please bear that one in mind because I will ask you as well. But I'm coming to Jeff now. And Jeff, I'd like to get your thoughts on the big trends and perhaps any reflections if you can also weave it in on what we've heard from Graham.
Great. Well, first to Graham's friend who says that when he feels comfortable, he's going to go berserk. I'm a believer in the cycles of history. And if you go back, at least in America, but I think this is true in Europe, but if you go back to the 1920s, which followed World War I and the inappropriately named Spanish flu, what came out of that era was the Roaring '20s, the era of incredible growth, jazz, organized crime, gangsters, the real growth of telephones, automobiles, movies, radio. And I think we're going to see something like that, what we're calling the Roaring 2020s, hopefully ending better than the Roaring '20s, which ended in 1929 with the Depression. But what we've seen during COVID, we think, is some new trends, the working at home, different ways of traveling, but really the acceleration of existing trends. And one of those most powerful trends has been the growth of online commerce over the last 20 years, to the point where Amazon is occasionally the world's biggest company. And during the pandemic, from the first 6 months, from March until September, they saw revenue growth of 40%. That's on $1 trillion. I mean, it's no big deal to see a $20 million company hit a boom and see 40% growth, but for $1 trillion company to grow 40%. So we simply couldn't go to stores. We couldn't shop, along with a lot of other things during the pandemic. We saw that of those who had never bought online, who had never bought a single thing online, March 1st, 2020, within 4 weeks, 37% of them were buying online. Among those who did buy online before the pandemic, close to 50% were buying things online they had never bought before. They broadened their experience, particularly to buying food from supermarkets. We think those gains are largely going to be permanent. There are people, 35%, who do miss being in stores, like shopping without knowing exactly what they want to buy. But we think the footholds that online merchants have gained during COVID will remain and will continue to grow. Another change we see coming out of this is banking and cashlessness. We saw of those who've never had a bank account, about 25% established one during COVID. 7% of the whole population who had never banked online but did have bank accounts moved to banking online. And I think we're seeing, this was really the tipping point on moving to a cashless society. In America, 80% of us opposed cashlessness for all kinds of reasons. The things people like the most about cashlessness is they have a record of everything they do. And the thing that people dislike the most about cashlessness is there's a record of everything they do, depending on whether they're conducting legal or illegal business. But we had people in America who strongly opposed eliminating the penny, the world's most useless denomination. Well, the bottom line, as with shopping, is we had no choice. Most of us haven't touched cash in 10 months. 40% of us don't want to touch cash because we believe it could contain the virus. I don't think that's true, but we know that cash can have all kinds of other things on them. So I think we're moving very quickly. A trend that has been highly accelerated is to cashlessness. So we see just in the shopping area what we think are going to be some permanent changes. And then, of course, other things that get into what Graham said, and I'll just do this in 30 seconds. We think you're going to see powerful economic trends in all kinds of areas that are going to make up some of his predictions. We think a third of business travel will disappear forever. We think leisure travel, which largely has been people buying campers and staying close to home in the last 10 months, we think it's going to take 4 or 5 years before travel returns to 2019 levels. We expect to see a commercial real estate depression. I don't know a single person who runs an office who isn't asking, do we need all that space? Do we need any space? The happiest people in the world are those whose leases are about to come up, and the unhappiest are those who just signed. So we think learning is going to have some permanent hybrid models. We expect to see massive transformation. We're not sure to what extent and where, but coming out of COVID.
Thank you so much. Well, that's absolutely fascinating. Really appreciate the view from the other side of the pond and beyond. And now I'd like to go to Greg Svensson. Greg, I think you're probably no stranger to disruption, given your time in the capital markets and most specifically at Lehman Brothers. But would you like to give us your view of the trends from the perspective of sort of big finance?
Yeah, thank you. And I think I'll speak mostly about Africa, but what we see in Africa is very consistent with what we see in other emerging markets. And some of the points that Jeffrey made, I think, are also relevant in Africa, and perhaps with even more opportunity because there isn't the historical infrastructure that's built in there. So Africa and other emerging markets, the consumer trends are driving opportunity, and the challenges that we see specifically in Africa, the lack of infrastructure, the challenges around the energy grid, lack of unpaved roads, the lack of access to the internet. Those are things that actually create great opportunities. So, converting these problems into opportunities is meaningful. Of course, they've suffered through the pandemic like everybody else, but some of the demographic trends, which really drive the investment thesis, the reason I expect capital to be coming into Africa significantly is because of these challenges. They have an infrastructure need of, say, 100 billion a year, but also that the population is significantly younger than the rest of the world. So while they have massive population growth, at least 2.5% a year, 1 of every 4 births in the world occurs in Africa. And so they'll be a significant player over the years, as you see. The trends in birth rates are lower virtually everywhere else in the world compared to Africa. And also the GDP growth in Africa has been 2 times, in the last 20 years, it's been 2 times what it was in the prior 20 years, in the 80s and 90s. So, you surely can't ignore the demographic pitch of Africa, as well as the urbanization trend. And a lot of that's going to drive the consumer trends, and the consumer trends will drive investment trends. So it's a two-way street. The consumer trends will definitely drive foreign direct investment, but also to a great benefit for those very consumers. So that's an exciting prospect. I think I'll speak a little bit about technology, because Jeffrey mentioned that, and we're seeing, interestingly enough, Africa and other emerging markets adopted mobile wallet and mobile payments much sooner than the West did, because they didn't have the banking infrastructure, they didn't have retail banks and transportation methods. So it's an opportunity. And right now 40% of Africans do not have access to consistent internet. So we think that's an opportunity. I think mobile is a massive business, and we expect to see, after a 10% drop in foreign direct investment in Africa in 2019 because of commodity prices, and then a 25% drop in 2020 because of the pandemic, I think you'll see a huge upsurge. And a lot of that, again, is going to be driven by consumer trends, starting with tech, but also in other things like agriculture, like solar energy.
Okay, thanks so much. Warm welcome to your dogs, and glad to know that they're okay. But you're touching there on digital, and one of the questions that we've been asked is, do you see a rise in global digital currencies?
Do you want me to start? The answer is absolutely yes. And
good answer.
No doubt. Look, I think what you've seen just in Bitcoin in the last 6 months, I had people tell me, you must own Bitcoin last summer, August, September, when it was at $11,000. Now it's in the high 30s or even low 40s. And that's driven by, I think, some of the things that Graham mentioned. That's driven by money printing. So it's a massive hedge against the massive money printing that's going on. And also digital transfer, value transfer is just becoming more important to all industries right now and consumers.
Okay, thanks so much. Really warm welcome then to you. And now to our last panelist, Kurt Beyer from the Vienna Institute, Economic Institute. But Kurt, you're so welcome. And I saw you sort of shaking your head there a bit at the talk about digital currencies. Would you like to sort of give us your overview of the big trends? And if you can weave in any references to previous answers, we'd be really fascinated. Thank you so much.
Okay, thanks a lot. Yeah, I would like to start with where the world economy is. I mean, we had last year in 2020, we had the first year since 1945 that the world economy shrank by 5%. The World Bank now says for this year, they think growth will be flat, 0. And that's why I disagree also with Graham, that I think the recovery will be very slow and protracted, very, very slow. Because there is something also on the business side, like we have in the labor market, where we talk about hysteresis. Long-term unemployment kind of gets ingrained and doesn't get out very easily. A lot of businesses will have folded, a lot of demand will have changed, a lot of supply chains will have been interrupted, some of them have died away. So there's a long, long hold back, I think, and it will take a long time, and it will take a lot of effort. And that's where I would like to put my emphasis, that very many of the trends that we will see will be very strongly policy driven. And of course, I have a little bit more of a normative approach. If we see where the problems were already before the COVID crisis, and which have been exacerbated by the crisis, we see essentially 3 big things. The one is the climate crisis. The other one is a social crisis, if you want, a crisis of social cohesion. And of course, we see now that we have some kind of a healthcare crisis. So my point is that if you look at the structure of our economies, we have private consumption, we have investment, and then we have the government. Anglo-Saxon economies had before the crisis and still now a higher share of private consumption in GDP. As a result, they have less investment and less government expenditures than the other European countries, at least. And probably there's a catch up they have to do, but also, of course, the continental European economies will have to invest more into the provision of public goods. We need to invest into climate crisis. We need to invest in social services. We know that the number of ICU beds or hospital beds has not been adequate. We need some kind of a reserve there. So, you know, we knew that we had these big problems of getting the personal equipment, protective equipment, and all these kind of things. So it seems to me that one of the lessons of the COVID crisis will have to be more, there has to be more capacity in our countries for health. And we know, of course, that long-term care is one of the other big wounds in our aging societies. I mean, I don't, you know, Austria is a dinky little country, but we have about, 4 million employees. We have about 40,000 foreign, mainly Eastern European care persons who take care of Austrians because the Austrians don't want to work at these conditions or whatever, the wages are too low, but there is a tremendous demand. And we saw during the COVID crisis that many of these Bulgarian or Slovakian care persons could not go back home, could not come back here. So there was obviously a big disruption. So my point is that the economic policy direction will have to be, we have to invest more into the provision of public goods, which are collective goods, which the private market does not provide in an adequate amount. That doesn't necessarily mean that all this has to be provided by the government itself, of course. We need the private sector to do this, but there needs to be initial and important government investment. Also, of course, with digitalization, 5G development, the networks for energy and so on, is something which is a public good provision. So it seems to me that in spite of the high savings rate, which Graham rightly mentioned, of course, we also have to see that not everybody in our societies has high savings. We know that 40% of Americans don't even have $100 in their savings accounts. And smaller numbers maybe in continental Europe, but still, there's obviously a large division, but still, there's a pent-up demand, that's very clear. But some of that will have to go not into private consumption, but will have to go into public consumption. And that, I think, we can talk about some more details about that. But it seems to me that this is going to be the trend and the necessity if we want to have built back better. I don't like the term very much, but we don't go back to the old times. We have to build a better society and a better economy. And that, in this instance at least, needs more public good provision.
Thank you so much. Really interesting thoughts. And I'm getting quite a few questions now from our audience about the impact of climate change on economic trends and whether climate change will also stimulate greater local sourcing and perhaps onshoring of procurement. And I'd really, because Graham has got to leave early, I'd like to come to you, Graham, again, just for a response on that one, please.
Yeah, I mean, I would actually link in the climate change stuff, particularly the onshoring stuff, with COVID, obviously there. I think you can combine it as well with the technology effect. You know, I think one of the major changes in international trade flows over the coming decades is going to be the impact of 3D additive manufacturing and how it returns manufacturing to the advanced economies. I mean, many places. Again, this is not something that's going to happen overnight, but the technological advances already underway and already achieved speak of the potential there, and it could be massive. I mean, with regard to climate change and its economic growth impact, I think the more direct impact at the moment is just the transformation of so many sectors. And most obviously the automotive sector. I've been doing some work recently on it, and to see, I've been looking at Jaguar Land Rover, and to see that the scale of investment there in electrification and autonomous vehicles and the devotion of resources to an utter transformation of the company. And that's the same across all the major auto manufacturers. That's just one example of a very significantly affected sector. But it does show you that now actually what we're seeing is a supply side shift in the economy as a result ultimately of the response to climate change. Now, what I would think I'm kind of comfortable with that one. What I wouldn't be comfortable with, I think, from a UK economic perspective, is the thought that we're actually going to shift public investment massively on a public sector basis towards doing all sorts of things which may or may not actually in the ultimate have any effect on climate change. But I think there's a weakness here, and there's a temptation to go down the public investment route a little bit too far in some of these areas. And so I'm a little cautious there. I'm comfortable with the supply side changes because it's got some market-led response preceding it. I'm a bit more uncomfortable than the other. But Kurt and I have I saw the finger wag.
Yeah, absolutely.
Kurt and I have crossed paths on this one before.
I'm sure. I can imagine. Kurt, I will come back to you, but I would like to come to Jeff and get some thoughts on. We're getting a lot of questions now, but on the climate change impacts.
Sure.
Clean air zones is something we're seeing a lot of in Europe. That's impacting on no cars in the city centres and so forth. Clean air apparently is something very, very high up people's agenda now post-COVID. And if you've had any thoughts as well on the local sourcing, and does it mean an end or a great decline in our dependence on China and buying cheaper products from China?
Sure. Well, first, I know Graham really does have a commitment, but I've just learned I'm going to start now every conference saying I have to leave 5 minutes early. What a nice, anyway, we track and we're interested in consumers. And one of the things we saw with COVID is that people say, now we'll be there to track and see if this is just a sentiment they share while they feel the walls are sort of closing in. But consumers, citizens say that coming out of this, they want to be more spiritual. They want to be more charitable. They want to value relationships with friends and community much more than acquiring goods. And we did see, incidentally, some of that following the Depression in the 1930s. My father, who grew up in the Depression, 50 years later, when he was a successful businessman, he still carried some of the baggage, some of the conservatism, particularly where money and jobs were concerned. All of that, I think, translates into we really are going to try to do more, at least in the beginning, and some of us will sustain it, to make the world a better place, to build better communities, to buy more locally. China has been, problems with buying from China have been coming to the surface for a long time. I think they're about to boil over. They're both political, economic, safety issues. But I really do tend to believe, people, that this has been a religious experience. This has changed, I think, some of us in very powerful ways. And I think we're going to look at what is important in life. And I know that may sound naive to some, but I really think this experience is going to be seared into our consciousness as we move forward. And we're going to look at the things and people we care about, and clean air and climate are those things. And we're going to try to move away from the things we don't care as much about.
Thank you so much for that, Jeff. And I'd like to turn now to Greg, and whether Greg feels that these trends in terms of the public good, which were very much echoed in some words that I heard from Professor Steve Evans from Cambridge University recently, in terms of the prioritization of trust looking ahead post-COVID, that the public really wanted the public good prioritized. Do you see that as a continuing trend from the side of the investor, and also in terms of the developing markets in Africa, particularly given your focus there?
That's a great question, Beverly. And I think everybody has the same concerns and sees that these issues are relevant. The question is, how do we address them? And I would argue that the private sector is, I probably more agree with Graham than Kurt. The private sector is a much better allocator of capital and resources. So, and we've seen that in Africa, with there's a departure from that top-down, donor recipient type of investment. It's not really investment. It's more relief, to a more, dynamic private investment. And again, a lot of that's driven by the consumer. We've, the interesting part about, Africa and other emerging markets is there's great opportunity in that bottom tier of Maslow's hierarchy, food, shelter, energy, just the basics. And I could argue that technology, or at least having a mobile device that works, is is part of that basic needs now, that didn't exist 50 or 100 years ago when Maslow came up with it. But, that creates great opportunity driven by the consumer trends in Africa and other emerging markets. So I think it's a great opportunity for the private sector to allocate. And let's face it, the governments don't have the money. In the West, we've spent so much money in the last, 9 months or 12 months with the pandemic. There's just so much money you can print without running into some really, unexpected consequences. And in Africa, they have very limited capital at the government level. So the trick is get private investment in for the operating expenditures and let the governments just use, the governments can employ, the capital expenditures have to come from the private sector, and then the operating expenditures or guarantees of some sort can come from the governments or the utilities, whoever's using the energy or using the mobile data. So there's great opportunity. And yes, impact is huge. And I think you've seen post-COVID, it was a trend anyway, but impact investing is here to stay. It's gotten much bigger since the pandemic, but it's opportunity. The best welfare is job creation. So we get capital into Africa and other emerging markets, creates jobs, economic uplift. Yes, feeding people. Yes, getting protein into getting people to that next level in the hierarchy from, durable crops, from eating wheat and rice to chicken or whatever protein you choose. But more importantly, getting economic uplift, export crops, and you mentioned, Beverly, the African trade agreement, or at least in one of the emails, that's going to be a huge benefit for consumers in Africa.
That's marvelous to hear. Very good to hear. Well, Kurt, now is your chance to answer some of these points that have been made with the focus on public good, climate change, sustainability, probably in every aspect of our lives. And perhaps you could also address this issue of inequality and this rising gap between rich and poor, which perhaps some would argue the private sector driven model has exacerbated in our Western economies. Be interested to hear.
Exactly. I would just like to echo your last words, because when we talk about the benefits or whatever benefits of the private market versus public policy, we have to see, or at least it is my I think assumption or my analysis, that where we are now, that we have the climate crisis, that we have these under provision of public goods, that we have this very, very wide dispersion of incomes in our countries, that is part of the doings of the private sector in the last 20, 30 years. And of course, there has been policy trying to do that, but we have to recognize, or we should recognize, that we've had for the last 30 years a public mindset which was favoring the private market over the government, over the public sector, different from country to country, we know that. So I don't think that the private sector by itself will solve the problems which it created. And you need, of course, the private sector to help remedy these things, but you need, and it is the responsibility of the government to get a socially cohesive society. Otherwise, we do get what we see in the storm on the Capitol and the 40% who still in the US and in our countries, where polarization not only of incomes but also of public opinions, of political opinions, is really starting to tear our societies apart. We have to just recognize that and try to do something. And to address Graham, I don't think that it is a question of private investment versus public investment, even though the UK has about 2.5% of public investment in terms of GDP. Sweden has 4.5%, and of course, nobody has 20, 30, 40%. The public investment can only be an initiator somewhere. And I think that's where the role is. We can talk about whatever the role of government in technological developments. We can talk about Mariana Mazzucato's analysis of how much the government has facilitated technological development and innovation. One doesn't have to believe everything she says, but still there is something to it that the government in many respects and also has the responsibility to create a better society. We cannot just rely on the private sector that got us where we are. But of course, not every government is benevolent. And that is, of course, also when we talk about Africa. I mean, Greg, we do know that more capital flows out of Africa than goes into Africa. That our old tenet that, you know, less developed countries are labor rich and capital poor. And so it is clear that the private market would go and flow into the developing countries. Unfortunately, because of political situations, the political instability, more capital is flowing out. And it's very, very difficult to get the private sector to invest in this very insecure situation. It's only, unfortunately, the public development banks, which are a small part of that, which try to remedy that. Also not, I'm not absolving the development banks of everything they're doing there or lauding them, but they at least they have a public policy view. So my feeling is we have to get the right mix, of course, and we have to really see what can governments do to get us into a better situation than we are now.
Well, thank you so much. Fascinating reference to Mariana Mazzucato. And I'd like to go to Jeff, actually, because one of the points Mariana refers to is, of course, the rise of Silicon Valley, which was founded and sort of bedded on a lot of government investment. And, you know, perhaps no coincidence that this enormous tech revolution began with the combination of fantastic entrepreneurialism and ability to convert early stage innovation into market ready technologies that you have in the United States that we look on from Europe with perhaps great envy. One of the questions I'm being asked is, you know, how much, with all of this polarization that Kurt is referring to, do you see that as a continuing trend? Obviously, you've had quite a bit of turbulence in America of late, in the past week or so, notably. And separately, sorry, completely separate question, but one I'm being asked is, when do you see a return to employment for the sectors that have been so dramatically hit by COVID in hospitality, travel, and those related industries? Could you answer those two questions, if you don't mind?
Sure. You're going to give me about an hour and a half for that.
I think you've got about 3 minutes, actually.
Very quickly.
Yeah.
You know, even the best economists I know have never been able to really get a good handle on why the Silicon Valley. You know, we seem to believe it has to be a great university. Good weather may have helped, entrepreneurial spirit, but that defines an awful lot of potential areas around the world. We ourselves don't know exactly what went right in the Silicon Valley, but, and incidentally, we're starting to see a migration of the established companies out of the Silicon Valley that is a little bit worrisome. But they have built wealth unlike anything we have ever seen, you know, in 25 years, becoming 4 of the 5 biggest companies in the world. And I'm sorry, Beverly, the other part of that, just with a word,
but the second question was related to return of employment levels, given the impact of
okay, I said earlier that I think what we're experiencing through COVID accelerated a lot of existing trends. I'm an optimist. It may have shown in my previous comment about thinking that people are going to focus on the more important things in the world. The only area I've consistently been a pessimist is on the future of employment. You know, I think we're on a path to every driver job in the world disappearing slowly, every checker job in retail slowly disappearing. And I worry about that greatly because, you know, just in America in 1900, 4 million people made their living through horses. Today, about 50,000 make their living from horses. And yet historically, the new industry, in this case, automobiles, creates more jobs than the old industry loses. That's not true anymore. And I think a lot of the jobs that have been affected during COVID, many of them, we don't know exactly how many, will not reappear. A lot will, but a lot of them will not. And I mentioned business travel. That's going to have a significant impact on hospitality. We're going to see with real estate in cities. So I think it's a real area we have to study, but I'm not optimistic at all that all jobs will return. Had there been no pandemic, we were losing jobs.
Really, you're not seeing AI, and one of the things that's often said is that there will be new jobs and they will sort of replace the loss of the kind of lower skilled jobs that you've mentioned.
Well, that's historically, what I said with regard to horses, the new industry but AI, we see 40 million jobs lost over the next generation in America. McKinsey says 850 million globally. AI will create new jobs. In America, it may be, particularly in healthcare, it may be 3 to 5 million, but we're not going to see a 1-for-1 or a newer industry that's big. There is no way that we're just not going to see fewer people employed. And that raises serious questions of depression, alcoholism, addiction, suicide, even civil unrest, not to be really, if left untreated. Because just, when you talk about psychology, even if we had guaranteed basic income and gave people the money they needed to have shelter and food, that's 10% of the problem. The other 90% is, what's my purpose in life? What do I do when I get up in the morning?
Yes.
So I think I win the award in this conversation from quickly flipping from the most optimistic person to the most pessimistic person.
Well,
depends what issue you get me on.
I've been asked one quick question just while I'm on you, talking to you, Jeff. Would you be able to say how countries have responded to COVID will affect people's desire to visit them? Sorry, I've just got one question on that.
I certainly, as we slowly roll out, it will. But if we're able to get herd immunity and ultimately eradicate the virus, and that may take 4 years, 5 years, I don't think it will have long-term effects. It'll have short-term as to where we'll go first. And I think we're going to stay closer to home than we historically have.
Okay, well, I'm going to just ask our other two remaining panelists, because I think Graham may have left us now. Kurt and Greg, coming to you first, Greg, on what would you recommend to young people? Where would you recommend they be looking now, given your knowledge of the current trends? What would you be recommending, given this dreadful potential loss of jobs that Jeff has cheered us all up with? Where would you tell young people to look?
Yeah, well, I'm not smart enough to know what the next great trend is. I'm sort of in an old economy business of creating, agriculture and infrastructure, building bridges and harbors, deep water ports and farming, so I don't know what the next sexy new thing is, but I can say that as we see even the movement within the United States, and you brought up, travel, a lot of people here are going to Dubai. Well, they were until 2 days ago because they took the UAE off the corridor list, but excuse me. But a lot of people are going to Florida. A lot of people are moving to Texas. Jeffrey mentioned, people leaving California. That's driven by policy. And I think you can see the trends in the US. And if I tell my kids who are in their 20s, move to a state with less government burden, regulatory burden, tax burden, and look at the movement. I'm from Illinois, and it's a shame to see what's happened there. No young people are moving to Chicago. It's the only state that's lost population for the last 10 years. And people are moving to Texas, Florida, Tennessee, the states where there's a robust and welcome business environment. And I think you'll see that from Silicon Valley, that people are moving to Austin, Texas, for example.
Okay, well, thank you very much indeed for that, Kurt. I'd like to come to Kurt and just ask you the same question, Kurt, about what would you be recommending to young people right now in terms of big trends?
Well, I mean, you know, that is not maybe the sexiest type of occupations, but as I said before, we are all living in aging societies. We need to have better personal care for aging persons. All of Europe is aging. Some countries have already completely declining populations, and you have to make care and health services and wellness services more attractive, obviously, that people go into it. It's a very hard job. It is very poorly paid. We all know. I mean, we had the essential workers, you know, everybody was applauding them. In Italy, they were standing every six o'clock in the evening on the balconies, singing and so on. But these are the worst paid people in our societies. Plus the people who also, that's a new job, which didn't exist 10 years ago, all the delivery people who bring us the commercial stuff that we order from Amazon or from other things. And so if we don't see that we also have to improve the working conditions and the salary conditions of these people, then we get a social big problem. Of course, now, at least where I come from, we used to have a lot of immigration from Eastern Europe because the wage differences between Austria and Bulgaria are about 5 to 1 or something. So we could move freely in the European Union. You also know in Great Britain, of course, you got many Polish plumbers and other people there. This is coming to an end, but you still have third country immigration. And so, of course, to some extent, we get enough labor potential there, but we have to train people and we have to train them in the right things. But it's not only in these personal services. I mean, at least in Central Europe, you still have a large potential in this whole digitalization of the economy, where there's not enough training yet, or where our, you know, the Austrians and the Germans and the Swiss, they pride themselves of their apprenticeship systems. But these apprenticeship systems are 1950s mindset. They are compartmentalized. They're just not fit for purpose for what we have to do. So there's a lot of things we could do, private sector can do, but I think we always have the misconception that the digital economy will replace jobs completely, and then where are the new jobs? We see much more that many of the job portfolios of individual people, especially in manufacturing, they change quite a bit. The digital part becomes larger and maybe the physical parts become smaller, but still the machinists are still there. They still do this, they do more of that. And so it seems to me that if you have better on-the-job training, lifelong learning, then you have a better situation than you have if you just try to maintain the old systems of training.
Well, thank you very much. And Greg, I think I might have called you Kurt, apologies for that. But Kurt, thank you very much. I think you have the last word there, as we are just coming up to 3 o'clock British time. I wanted to thank our panelists for a fantastic, lively conversation. Graham Leach, Greg Swenson, Jeffrey Cole. Jeff, thanks so much for joining us from LA. And it's, I know, a rather unsociable hour of day, and
well worth it.
It's been marvelous to talk to you all, really inspiring. And I've taken a few notes for any young people on the line. Sounds as though we can rely on some construction going on in Africa. The digitization agenda, I think, continues apace. I think, if I've understood Jeff, healthcare is something that we're going to need with our aging populations, and maybe to look after and think about more our key workers who really have become visible in the crisis in a way that probably none of us ever knew what a key worker was before. Education needs continue and lifelong learning, more of a focus. And I think, Jeff, all the way from LA, I took a big I applauded personally your emphasis on communities and placemaking as a local councillor myself in Malvern, Worcestershire. I hope you won't mind me mentioning it as one of our closing words. Now, I do just have to say that this was our first webinar. A very, as I say, big thank you to each and every one of our panelists, to our audience for your questions. I hope I've asked them all, or have certainly attempted to. I'd like to flag up that there is a post-webinar questionnaire, and please do complete that to members of the audience online. And the next webinar is on Thursday, the 28th of January at 2 p.m. on the technology transforming healthcare. You'll be interested to hear Kurt, I'm sure, and everybody online. So thank you all, real pleasure to meet you all, and look forward, I hope, to meeting you again, but preferably in real life. Thank you.
Great. Thanks, Beverly. Thank you all.
Thanks so
Great to
much.
meet you.
Thank you. All right, bye-bye.
Thank you, everybody.